A new year, a new start, and new trends for the financial markets. With me to discuss what to watch is Francis Hunt, the market sniper. Well, Francis, the major talking points for the year ahead probably start with low oil prices and, of course, interest rate rises. We have recently seen the Fed raise rates by 0.25%, but we're still wondering whether the Bank of England and the European Central Bank will follow suit. So how should traders approach this uncertainty in markets?
It's very interesting moments at the moment. I tend to be, both as a trader and investor, focus on what has been the key trends that have come into the cusp of a new year. It's always the better policy on balance of probabilities to go with the existing flow. In other words, calling the bottom or calling the top in certain things invariably is a very painful game. So in terms of oil, which you referenced, a number of times when it looked like we were getting a bit of a bid under oil, a number of people were tempted to come in and say, well, I'm a buyer now, it's got to bottom out, it can't get lower than this. Whenever people start saying it can't, and there's that sort of imperativeness about something, they're usually too emotionally invested in that idea or trade, and you'll be shocked at what can. Keep staying short the commodities is one of the carryover points that I'm taking into the new year. Also, emerging markets. This one's a big one for me. In terms of just forward projecting the current trends, a number of crises in a number of the key markets. So that would be South Africa, Mexico, so the ZAR, ZAR for your FX, the MXN, that's the peso, potentially the Turkish lira, Brazilian real, Indian rupee, these kind of areas. Why? Because we've just had a dollar-based increase interest rate, so that cost of that capital is going to cost a little bit more. Yes, it's very slight and it's not going to go very far, very fast in my view, but it's a step in the wrong direction for people that are sitting with lots of dollar-based debt. Then you add the crisis in commodities, that interest hike, dollar strength, more sell-offs in the commodities, and they're getting squeezed on both fronts, and eventually things start to creak.
Well, of course, for those invested in dollar stocks, it's not a good time, but following the Fed's rate rise, where are the opportunities?
There's a lot of big investment banks that are coming out with, there's going to be 3, maybe 4 moves during the course of this year, and I think they're getting a little too excited. Don't believe the underlying strength that Mademoiselle Yellen is putting forward is as robust as people think. So I think we're going to be on the underside on the rate that interest rates are going up in terms of what's being guided for the investment banks. This is going to be one of the meekest and most mild bottoming out cycles, and there is even scope for backward steps here. It can be a bit egg on face, but who knows? You could have a principle where there's actually some quantitative easing going on when effectively you've actually had a marginal tightening in rates. Sounds perverse. It sounds like pouring water on the fire on one end and petrol on the other, but we're not strong globally, and I'm on the sort of the bearish side macroeconomically on the global context.
Well, this all sounds a little bit negative. This isn't a good time to be a trader then?
It's a great time. It's a great time. In fact, on the mid-cap US stocks, we're getting lots of excellent setups for selling off shorts. So if you're a trader, be there. If you're a long-only, non-leveraged investor, you've got to think carefully in terms of where you put your money. The one thing that did well in the year that goes by, so just to balance out, I suppose, my bearishness, is what's known as the FANG category. Facebook, Amazon, Netflix, Google, etc. In fact, I fear they've done almost too well. Will they be able to carry that momentum? I think for a while, potentially, but they can't be successful in a void. If the retail buyers go to ground and everybody else is feeling too far gone pinched, we'll start to see a little bit of withering on the vine on that trend too.
Well, there are multiple trends that point to a volatile forex market in 2016, but the world's economic lenders have also suggested that the world may well face a recession next year. Do you think this will really push forward short-term trading?
Time frame on trading is an interesting discussion. People need movement, and that's volatility. I don't think it necessarily has to tie directly into time frame, but what it does mean is if you're an investor and you tend to be on a larger view, you could have very abrupt moves against you. But in terms of stop losses and their placement in a highly volatile environment, you've got to be very selective where you enter a market and for how long you're in the market. Because if you have an open trade, that by virtue of the volatility, you can be shaken out.
And back to emerging markets, how do they fit into this?
Well, the big thing for me is the forex on the emerging markets, and I think that'll affect almost everything, because I think that debt, typically the share for a country is its currency, in a very layman's kind of view. The nature of the debt costing more, the squeeze on the commodities particularly. We are actually predicting another ruble crisis, actually. We caught the first one prior to the Ukraine hostilities. We didn't know what the triggering event. That was in the charts, and we're seeing that coming up again. So I think there's also potential for geopolitics reheating up, which is going to be for specific emerging markets. It's obviously very specifically oil and energies and Russia per se. But I think the others will be getting knocked generally, just for lack of demand and a squeeze. One of the things I look at is copper for the China recovery, and it's looking in terrible shape. You know, each time we're seeing a grind line, it's spilling. So there's no bottom there, and that's the big construction. It's one of the big industrial metals for the construction model. So that was leaking long prior to the news coming out with China. So there's a lot of leading indicators I would advise people to watch. Japanese yen, a little bit of a fear currency when it gets really scary. So the yen gets a bid and could go up.
Well, we touched on political volatility. So how do you see this impacting markets?
There's a lot obviously going on in the Middle East, and it's not entirely clear who's on whose side. I think there's a financial warfare within that on the geopolitics, and that the overly reasserting dollar strength is the pain lever, as I mentioned, on certain markets, and that is giving them a bit of the frighteners and the squeeze. And then finally, China, worth mentioning on China as well, they made it into the SDR with the yuan, which is quite noteworthy, and they were probably on their best behavior as much as they needed to be, and they did devalue once. I'm actually calling for further devaluations on the Chinese yuan, and that's going to give a bouncy old time. So that might keep their share market up to keep the domestic investor happy, but it's going to be a currency effect in that's actually seeing a little bit of the steam and the bubble being released with the yuan being taken down.